Thank you for joining us today. My name is Matt Hilland. I'm a financial planner here at Arnold and Moat Wealth Management. And this month we're talking about charitable giving strategies. This is particularly timely as we approach the end of the year. A lot of people are thinking about how to give to charities that they want to support. And so we're going to be looking at different ways that you can donate using your investments, whether it's an IRA or a brokerage account. Also look at the role that estate planning can play in you providing support for charities that you care about, and then giving a few examples along the way of how charitable giving strategies and financial plans can work together to both benefit the charities the most and then also provide you with the best, tax deduction and other benefits. So first to start, why is this an issue at all, and why does it take some financial planning to get you the best deductions possible for your charitable contribution? And the big reason is that the Tax Cut and Jobs Act from about 6 years ago dramatically increased the standard deduction. This is the deduction you're able to claim on your taxes, with no questions asked. And for 2024, if you're a married couple under age 65, that standard deduction is $29,200. And so the federal government will give you that deduction from your income without any proof of certain itemized deductions, charitable contributions, or anything like that. And that's been good for a lot of households. Today, about 90% of households just file using the standard deduction. So it's simplified tax filing for a lot of households. But it did reduce the tax deductions that households that tend to give regularly to charity receive. And so, just for example, I wanted to show some numbers on how a tax return would look for, again, a married household under age 65 who maybe has about $10,000 in state and local taxes that they pay. This is the most that you're able to deduct on your federal tax return, by the way. Might have a mortgage that you're paying some interest on. Of course, that's tax deductible. And then you give some amount to charity. And so, just for this example here, we're assuming that this household has about $25,000 of itemized deductions that they're able to do. 7,000 of that comes from charitable contributions. And even with that, that sizable charitable contribution, their total itemized deductions is still under the standard deduction. And so if this household is giving $7,000 to charity every year, they're not really seeing an added tax deduction for that. And if they would choose to give something like $9,000 instead of $7,000, they're not receiving any added deduction for that added charitable contribution. And so this is an issue that a lot of households are running into. And there's a couple ways to get around this. The most simple is just what's called bunching donations. And that just means maybe give 2 years worth of donations at once. And so, for example, this household that normally gave 7,000 a year, maybe instead now they give $14,000 every other year. And so with this, you can see that $14,000 charitable contribution now raises their itemized deductions to $32,000. That's in excess of the standard deduction of $29,000. So now they're able to get a $32,000 deduction, or, not quite $3,000 more. And, this is not life-changing here, but at least now they're receiving about $2,800 more in tax deductions every 2 years than they would have otherwise. And so this is a strategy that a lot of people have been using, and it's good, it's better than nothing, but there's some, a lot better ways to go about this that we kind of wanted to talk about. One of those is what's called a donor advised fund, and it's the same idea of lumping together donations, but a little bit easier. What a donor advised fund is simply a charity account whose sole job is to distribute money to other charities. When you make a contribution to a donor advised fund, that's your charitable contribution. And then over time, you can designate that the donor advised fund effectively donate money to other charities. And so if you give, for example, $6,000 to the donor advised fund, you can then tell the donor advised fund to make a $2,000 donation to one charity, a $2,000 donation to another charity, and a $2,000 donation to a third charity. And so, although ultimately you may be giving your money to multiple charities, what really matters is the one donation that you make to the donor advised fund, and you receive a tax deduction for that one contribution to the donor advised fund. And just to put some numbers on how this would work, looking at that same household where they were donating about $7,000 a year, this table is showing if they would group 4 years worth of donations. So in other words, give $28,000 to a donor advised fund in year one, and then just claim, not do any charitable contributions for the 3 years after. That one large lumped donation to the donor advised fund gets them a much bigger tax deduction in year one, and then they get that same standard deduction that they would have always received for the next 3 years. But over a 4 year period, they would receive about $16,800 more in tax deductions than if they had just kept doing that $7,000 a year. So this can be really beneficial for those that can take advantage of a donor advised fund. And donor advised funds have a few other benefits compared to just ordinary cash donations. I had mentioned that they're good for kind of lumping donations, and donor advised funds make it very easy to contribute a large amount now, get that charitable deduction for that large contribution, but then using a donor advised fund, you can distribute that money over many years. And so some people might just be uneasy donating $28,000 at a time to a charity. They might want to give regularly instead. And donor advised funds make this much easier to get the deduction of a large lump charitable contribution, but still distribute that over time. And in addition, there can be money, like I said, sitting in these donor advised funds for many years. The assets inside of donor advised funds can be invested and can grow tax-free. And so you can put $28,000 in, but invest that over time, and maybe it's $30,000 or $35,000, 4 or 5 years from now. And now you have a little bit more money that you can give to charity. And besides just donating cash, donor advised funds are really advantageous because you can donate appreciated securities to them. So if you have 100 shares of Apple that you bought 30 years ago, you probably don't want to sell those and recognize the capital gains just to then donate that cash to charity. Using a donor advised fund, you can donate the shares directly. You get a charitable deduction based on today's value of those shares, and you don't have to sell those shares and recognize the capital gains first. This is also nice because a lot of small charities just are not equipped to handle direct donation of shares. Very large ones, Red Cross and United Way, probably have no problem taking 100 shares of Apple. Your local animal shelter might not be able to. And so donor advised funds make this really nice, or even for small charities, you can effectively donate them appreciated securities, save yourself on taxes, and help out the charities that you want to help out. It also simplifies record keeping. It gives you one receipt effectively for your charitable contributions for the year. Again, that one contribution to the donor advised fund is what is your charitable contribution. You don't have to keep receipts for all the charities that you donate to from the donor advised fund. So if you donate $10,000 to a donor advised fund and then give $1,000 to 10 charities, you don't need to track down those 10 receipts. Keep those 10 receipts during the year, get them to your tax preparer, and hope nothing gets missed. It's one receipt, the $10,000 contribution to the donor advised fund. And donor advised funds can also help you donate anonymously if that's something you're worried about. Sometimes it can be hard, especially to donate appreciated securities anonymously. This will make it much easier. And so donor advised funds do have some costs and some limitations to know about, though. So these are run by any of the big custodians that are out there. So Schwab, Fidelity, and Vanguard all offer donor advised funds, but they charge a fee to administer these accounts. And all three of these companies are on the same basis here with about 0.6% for their fee. So you have to be comfortable knowing that that fee is there. It does go down on assets, but very large amounts over like $500,000. They also have minimum contribution amounts. Schwab and Fidelity do not at this time, but Vanguard, if you wanted to start a donor advised fund there, be ready to at least have a $25,000 initial donation. And then there's also minimum grants. So these grants are what's going out to the charities. So from your donor advised fund, if you want to send the animal, shelter, a donation, that's a grant from the donor advised fund. Schwab and Fidelity have about a $50 minimum. Vanguard has that little bit higher minimum. And so if you want to give a lot of $50 or $100 gifts, Vanguard might not be a great place for you to have your donor advised fund. And then there are some limitations for the tax deductions you can receive for donor advised funds. This is not meant to be an exhaustive slide. This slide is our way of saying it's worth it to talk to a financial planner or a CPA about this before you do it. The worksheet that we're showing on the right here is the worksheet you'd have to complete on your tax return if you do a donor advised fund contribution. And this is what calculates how much of your contribution is tax deductible. And, just at a high level, know that there are some limitations out there. In general, if you fund the donor advised fund with cash, you can deduct up to 60% of your adjusted gross income during the year. If you use appreciated securities, so donate those Apple shares, you can deduct up to 30% of your AGI. If you go over this, you can carry over the deduction amounts to future years. You just have to make sure you'll be able to use it. And of course, all this is subject to change. I put in 2026 because that's when Tax Cut and Jobs Act expires. It's really any time, though. Tax laws can change at any time. And so you want to make sure that you are up to speed on the limits today that exist. And just to give you an idea of what some real dollar benefits could be, I mentioned donor advised funds are great for donating appreciated shares. It doesn't necessarily have to be Apple shares. It can even just be that mutual fund or ETF that you own in your brokerage account. And so just for example, let's say 25 years ago, you purchased $5,000 of an S&P 500 index fund. Today, that's worth about $33,400. And if you were to just sell that $33,400 worth of funds, you would pay capital gains tax on that investment, which for most households is 15%. That means you would have a $4,260 tax bill. And so if your first idea is to sell your investments, get the cash in your bank account, and then write a check to the charity, that could cost you, in this case, about $4,000 in added taxes. Instead, you could just use a donor advised fund, directly donate those shares of that S&P 500 index fund, not pay $1 in capital gains tax, and then donate the charity $33,400. And so even if the tax deduction is just not that big of an issue, using a donor advised fund like this can help save you taxes on your investments. And then besides using a donor advised fund, which is typically used when you have a brokerage account, there's a really good way to donate using your IRA as well. This is only available if you're age 70 and a half, and it is 70 and a half for some reason. So if you're 70 in 1 month, don't do this yet. But once you're 70 and a half, you can donate directly from your IRA to a charity, and that money is not taxed as it leaves your IRA. And if you have required minimum distributions, that can offset or that can count towards your required minimum distribution for the year. And so you are limited on these types of donations. For 2024, it's $105,000. It'll be going up a few $1,000s in 2025, and it is inflation adjusted. So over the years, expect this to grow modestly. But how this works, for our clients at Schwab, we can give them a checkbook for their IRA that's used only for donations. They can write a check to their charity just like they would write a check from their checking account. Only the money comes right from your IRA. And then we can provide your tax preparer some documentation to show them, hey, this $1,000 that came out of the IRA was for a donation. Don't include it as taxable income on their tax return. And so if you are 70 and a half or older and have assets in your IRA, quite honestly, this is probably the primary way you should consider donating, unless there's some really big donations we're going to talk about here in some future slides. But for your regular ongoing donations, if you donate under $100,000 a year, QCD is probably your best way. And just to, again, put some numbers on this, let's say you wanted to donate $10,000 from your IRA. A lot of people's first instinct might just to be get that $10,000 into my checking account and then write a check. But if you do that, you're paying income tax on that IRA withdrawal. And so just for example, if you're in the 22% income tax bracket, that's going to be a $2,200 tax bill. And effectively, that means after taxes, $7,800 is hitting your checking account, and that's less money for the charity. $10,000 came out of your IRA, the charity's not able to get that full amount. Using a QCD, that $10,000 in your IRA goes directly to be $10,000 into the charity's bank account. It doesn't hit your checking account on the way, no taxes are withheld. It's very slick, very easy. And again, not only are we benefiting the charity here, we're saving you a $2,200 tax bill. Now, besides just using your investments or some cash flow now, estate planning also has a big role in creating a charitable giving plan for you. One thing that's become really popular since the Secure Act is what's called a charitable gift annuity. So these have been around for a while. They, in general, just involve donating a sum of money to a charity, and in exchange, you agree, or the charity really agrees, to pay you a certain amount of income for as long as you live. Once you pass away, the charity receives what's ever left of this lump sum. Why these have become popular recently and what I want to focus on here is because lately they can now be funded by a QCD. And so again, this is you're over age 70 and a half. You can move money tax-free from your IRA to a charity and get some amount of income from this. And then once you pass, the charity takes over what's left. You're limited in how much you can donate this way, though. So if you want to use your IRA and use a QCD to fund this, you're limited to $53,000 max per person, and that's a lifetime limit. So a married couple could do a total of $106,000 in donations this way. And if they would do this, you would expect about an annual payment of $5,300 from that $106,000 donation. And so if you do this charitable gift annuity through a QCD, of course, you don't get an added tax deduction. The benefit is that you're getting $106,000 out of your IRA tax-free, but you can also buy charitable gift annuities just with money in your checking account or cash in your brokerage account. If you would fund in this example $106,000 just using cash outside of a retirement account, you could get a tax deduction today of about $34,400. And so this is a good thing to do. A lot of people like doing this because they feel like they're committing some money to charity, but also able to receive some amount of income. I think it's worth saying too, this can be a risk for charities, honestly. A small charity, if they receive $106,000 and both you and your wife end up living to be 110 years old, the charity's going to actually lose money on this because they're going to have to keep paying you. That $106,000 is probably going to be spent down from those annual payments. And so I think that's just something to consider is that, for a lot of people that have the capacity to do a $100,000 donation, I don't know if $5,000 in annual payments is really making a huge impact to the plan, and it might not be as beneficial as you want it to be. And so again, can be right for a lot of people. Also, just a few things to be aware of. It's probably not a life-changing, charitable giving strategy. For those that are considering some of these really large charitable contributions, another option that's out there is what's called a charitable remainder trust. There's a few different types of these, so I'm simplifying this there. It's the same general idea as a charitable gift annuity in that you're making a large contribution to a trust and getting some kind of income over the course of your life or a beneficiary's life. Charitable remainder trust, though, adds some complexities because you can have multiple beneficiaries of the trust. So when you pass away, the money that's left over in the trust can be split to many different charities if you'd like, compared to a charitable gift annuity, which is typically just for, one charity. And so these are popular for really large types of donations. And they're popular for people that want to donate but are just a little bit afraid of giving away all that money kind of early on, right? Where we don't know what future expenses are going to be. This allows you to get some kind of income, help you feel a little bit comfortable, but have some money set aside for charities for when you pass. And there's a big caveat here that these are expensive to kind of create. You're going to need help from an attorney, probably a CPA. You probably want a financial advisor to work with you on this. And so this is not something you use for a $100,000 donation. But just to give you an example of how this can look, a married couple here, age 65, who maybe they just sold a business, had some investment real estate that they cashed out, have a lot of money, have a big tax bill for 1 year, and they want to figure out how they can support charities, also get them a big tax deduction. This can be a popular strategy. And so, just for example, today, as I type this, if you'd put $1 million in a charitable remainder trust, you could get about a 5% annual payout. These numbers can be adjusted too, so you can get a little more if you would like. Um, it could also just be either for your lifetime or for a set amount of years, but let's just say you do a 5% annual payout for your lifetime. You could expect to receive a tax deduction today of about $340,000. And so, remember, if you donated that $100,000, or I'm sorry, $1 million in cash to a donor advised fund, you could get a $600,000 tax deduction. So you're getting a lower tax deduction, but in exchange, you're getting some lifetime income from this that for some people I think can be attractive, right? It's tough to see $1 million kind of leave your accounts. And so at least having some income there makes you feel like you can pay for those necessary expenses that you need to and still have some money set aside for charity. Again, just know this is for larger donation amounts, and because of the costs that go into it, and not only upfront costs, but annual costs too. You'll need a CPA to file tax returns for the trust and make sure everything's in line. There's, hundreds, probably thousands of dollars in ongoing expenses to keep some of these alive. So it's not something you're going to use for, probably any kind of six-figure donation even. And then besides, if you aren't worried about just collecting some income from your investments, but you want to leave some money once you pass to charity, a really good idea is just to check the beneficiaries on your accounts and allocate them in a tax efficient manner. And so, for example, let's just say when you pass away, you have $250,000 in an IRA and $250,000 in a Roth IRA. Most people just kind of have all their beneficiaries on every account the same. And so let's say you want half your money to go to charity and half to a child. You'd probably put 50% of your IRA goes to the charity, 50% to the child, and then 50% of the Roth IRA goes to the charity, 50% goes to the child. And so how that would look is that, the charity gets $125,000 from the IRA, the same amount from the Roth. Your child gets the same. But what a lot of people don't realize is that your child is going to have to pay taxes when they withdraw that money from the inherited IRA. And so let's just say they're in the 22% tax bracket. That means after taxes, that $125,000 is really only about $97,500. And so allocating or setting your beneficiaries like this is really just leaving your child with, only about $222,500. If this person instead were to designate the charity as the 100% beneficiary to the traditional IRA and their child as the 100% beneficiary to their Roth IRA, now the child pays no taxes on the inherited Roth IRA. The charity doesn't pay taxes on the IRA because charities don't pay taxes. And now you've given the same amount of charity, but you've left your child $22,500 more. And so this is really important. It's a reason why every few years for our clients, we're asking you about your beneficiaries and making sure things are in line. And that's because if you intend to leave some money at the end of your plan to a charity, there's probably a big advantage to making sure those beneficiary designations are set right. And then I just wanted to end with one example just to show how everything can kind of come together here. And so we talk a lot about financial planning, investment planning, tax planning, estate planning, all that, and how a charitable giving strategy can kind of come together with your financial plan to, again, not only help the charity, but also help you the most. And one really common strategy we see is combining donor advised fund donations with Roth conversions. And so, just for example, I wanted to show you this is a married couple. They have $100,000 in earnings. They typically donate $10,000 a year. They expect to do that for as long as they can. That's in the plan, it's sustainable. But they don't have a lot of other itemized deductions, right? So, just like our first example earlier in this webinar, they're just receiving the standard deduction. And then they also have this brokerage account that they've had for a long time that's $150,000 in value with pretty highly appreciated investments. They bought the S&P 500 30 years ago and it's grown. So this couple just with this earnings, some interest and dividends that be expected based on this brokerage account balance, they probably have a federal tax bill of around $9,000. But then the financial planner comes around and says, hey, you would really benefit from Roth conversions. And so here's all the math, and this is why we'd recommend a $140,000 Roth conversion. And if this example household now added $140,000 in Roth conversion on top of their earnings, on top of their interest and dividends, they'd be looking at a federal tax bill just under about $40,000. And again, that's the trade-off with doing Roth conversions. You're paying taxes at a certain rate. This on its own can still be beneficial, of course, if we expect this couple's tax rate to really increase in the future. But, that's a big tax bill that you have to be comfortable with. But now let's think, now the financial planner also comes in and says, hey, I see that you're typically donating. Would you feel comfortable donating some of that brokerage account that you have to a donor advised fund, kind of lumping your annual donations together and and combining this Roth conversion with a large donor advised fund contribution? And so, we come to a conclusion of about a $75,000 donor advised fund contribution. And so now look at the bottom here. We've reduced that federal tax bill by about $13,000. This couple has an average tax rate of 10.4%. They're moving $140,000 into a Roth account for a relatively low tax bill, right? An average tax rate barely into the double digits. And, so this combines a lot of really great parts of the plan. They're going to save taxes in the long run with that Roth conversion. That's going to be incredibly beneficial to them in the long run. And they're going to be able to support the charities that they want for many years going forward. That $75,000 can be invested, it can grow, they can donate $10,000 at a time going forward. And here, this couple has not really done a whole lot different than what they were planning to do, but we've been able to save them five figures on their tax bill, keep their tax rate down, benefit charities and benefit them. And so just an example here, there's lots of kind of what ifs and variables that we see every day in these plans, but I wanted to give just a real life example of how some of this can all come together to, really work well together. And so that's all we have for today. Thank you. We know this is a topic that's incredibly personal. We try to show some examples here, give you a high level overview of different ways that you can donate. But if you have questions or know this is something that you'd like to do more, we want to hear from you. This is something that we can help you with and help clients with every year. And it's something that we really feel strongly about being able to help. And so hopefully this was helpful, but please know that we're here to help you take the next step, look at your specific situation and how these strategies, how you can take advantage of these strategies. So please let us know if you have any questions here. We're watching the chat for a little bit. And if not, reach out to us. And if there's no questions, have a great weekend and take care.